Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
Why commercial property? It's been the talk of the town since COVID, since interest rates hit at bottom 2%. It was an investment purely for the rich. It was an investment purely for business owners. And we've seen so many more mums and dads take the leap into commercial property. We're bombarded by advertisements, bombarded by the yields, bombarded by the level of passive income that it generates. But we're actually going to deep dive in today to make sure that commercial property investment is actually for you. And is it all that it's cracked up to be? I want to really go through and review some of the cons that I see with investing in commercial property. And I've brought on today a gentleman, Steve Palise from Palise Property, engineer by background, commercial property enthusiast, and one of Australia's largest buyers agents in the commercial space. I really want to challenge him today on some of the cons that I think and some of the things that people need to be considering before they go into commercial property. I'm going to try to leave nothing off the table. I'm going to ask the hard questions. I'm going to ask the questions that you should be asking yourself or your property specialist before you start to go down the commercial property path. I'm joined by Steve. Steve, welcome to What School Should Have Taught You.
Jeremy, pleasure to finally be on.
Mate, it's been a long time and we've got a long relationship, well over a decade, professional relationship as a consultant to you, and obviously got to see your portfolio change and pivot from, a large residential portfolio to now a very sophisticated commercial portfolio. But for someone like you who's got years and years of experience and dived into over 1,000 transactions, I really want to ask those questions of you today that people may need to consider before they're going into commercial property. And I'm really going to take that viewpoint of a challenger to make sure that people understand everything they need to know. And I want to kind of hit it off today with the first and foremost thing that we hear at the barbecue. And on this show, I always talk about people at the barbecue, but higher vacancy risk. Now, traditionally, commercial property, and there's, said by many of these influencers out there, property influencers and social property influencers as well, that you've got to expect anywhere between 6 to 9 months on average for vacancy. And that's a huge pill to swallow for a lot of mum and dad investors wanting to get into the property or the commercial property market. What's your thoughts on how to tackle high vacancy risk in the commercial property market?
Yeah, so first and foremost, it actually depends what type of commercial you're buying. And this is where the myth comes from. People just package up commercial around Australia as one item, but it's not. You've got industrial, you've got retail, you've got office space. They all have different vacancy rates. So we'll touch on the highest one. Office space at the moment, everyone knows post-COVID vacancy rates have shot up. They were previously 6 or 7%, which seems high, but we'll go into a little bit later why that's not necessarily that high. And now the average is around 17 to 20% in the capital cities. So yes, vacancy rates are high, but that's also similar to if you went and bought an off-the-plan apartment in Melbourne or Perth, that had very high vacancy rates. That had 5 or 6% vacancy rates. If you buy in a new estate, I bought a house in Box Hill, as you know, back in the day, Jeremy, which is in northwest Sydney, that had vacancy rates of 7%. So purely saying it's got high vacancy rates doesn't actually help anything because it actually depends what you're buying. So office space, really high. Retail, it's really hard to get actually a grounding on what the vacancy rate is because it depends what you're buying. Most people aren't buying a Westfield shopping centre. They're buying a little cafe, hairdresser, medical centre. Depending on what and where you buy will have a different vacancy rate. So an example would be if you buy a little retail shop in a retail strip, you're typically looking at 6 to 12 months in a good area, so not a poor area, which seems like a lot, but we'll touch on later, you also get about 3 times the rent. So theoretically, you could have it tenanted for 5 years and it could sit there vacant for another 10 years and you're in no worse position than a residential. But again, there's buffers and things we'll go into a little bit later that. So retail, it's going to depend where it is, foot traffic, road traffic. If you buy one street back from the main street, vacancy rates can be years. You can buy in some prime areas where it's such in demand, there's no vacancy rate. There's waiting lists. So retail, a bit of a different one. You have to understand that class. And then the most simple is probably industrial because it is just 3 concrete tilt-up walls and a roller door. Different areas will have different vacancy rates. To give you the clickbait item, North Sydney has 0% vacancy rates on warehouses. 0.
Wow.
So that kind of gets a bit, but on average, you're generally looking around 3 to 6 months in the industrial class in the capitals at the moment, the major capitals anyway. But again, you're getting 3 times the rent, and the tenants are typically staying longer. On average, the tenants stay about 5 to 12 years, whereas residential, it's 1 to 3 years. And then you have 2 weeks vacancy. So collectively can be the same. But the hardest part of this is if you don't know what you're doing and you don't know how to assess the vacancy rates, that's when you'll get burnt. Residential's easy. You can go on SQM research and it'll give you a vacancy rate for the suburb for a 3 or 4 bedroom house. Commercial, there's a lot of digging you have to do to get the answer.
Yeah, and I want to, I've been very transparent on what schools should have taught you about my own property portfolio. And Steve mentioned about office space being a high vacancy. I recently have purchased office space for my own business to go into, and it's in a metropolitan area of Oran Park, so not necessarily a major city. And for me, when I was looking to buy there, number one, there was nothing for sale, and number two, rental market was actually quite tight because there wasn't a huge amount of office space in the area. So even though Steve may mention office space has got high vacancy rates, typically around major CBDs, there's always exceptions, and that's probably synonymous with what Steve just said, is that there's so much digging you've got to do. There's not just one platform to create one level of data metric to determine this. Steve, what would be the easiest...
Let's quickly touch on that because I can give a couple examples. So you're spot on. The data I gave was for CBD, and then I've kind of proved myself right in regards to saying people just look at the big data and kind of collective. Of course, there's areas within areas, and CBD is generally oversupply. Like you said, Oran Park, tightly held. We took about 8 months to find a client who was same situation as you, funnily enough, an accountant, and office space in Cronulla. And it took us more than 6 months to actually get them on because that's how tight it is. And another example is we bought an office space in Balgala, which is the Northern Beaches. It was a small building, the second floor, but it was actually a ballet studio. It was just in an office building, but the vacancies were tight because of that versatility. So there's always a nuance and a case by case depending on what you're looking for. And then, as you know, there's advantages if you're a business owner. If you're renting an office space at the moment, with the yields where they are with office space, it actually makes sense to pay it off as opposed to just rent it and pay off someone else's mortgage.
Absolutely. And then for the value of the listeners, what would you say at the moment is probably the most tightly held from a vacancy perspective? So the lowest vacancy rate that you're seeing, what asset class, and let's just say we're not focusing on regional or CBD, but what asset class is probably the most in demand for renters at the moment?
Industrial, definitely. And the easy way we can see that is 5 years ago, if you had a leased commercial industrial, you could sell it at a premium of around 15% more than a vacant warehouse. Now it's actually flipped. Property managers and selling agents are actually telling, once the tenant leaves, if you want to put it on the market, sell it vacant, because a vacant property will fetch around 10-15% more than a tenanted one. And the reason for that is the owner occupiers want it more than the investors, which is also a good sign for capital growth.
So it's interesting because normally what a lot of commercial property investors want to see is they want to have the property being tenanted, or people want to buy commercial property with a tenant already in place, because if it's vacant, they generally have to pay GST on top of the purchase price. So even taking that into account, not having a property subject to a going concern, meaning no GST exchanges hands because the property is being rented. Even with the property vacant, you're still hearing that it's better to have the property vacant than it is to have a property tenanted.
The investor who's selling the property doesn't really care that the person buying it's going to have to pay GST, but it's still also a good indicator of demand because theoretically, even if they couldn't buy it, they're going to have to rent a space because they've got a thriving business already. They need some space, which will further compress vacancy rates. And that's why we're seeing on like the northern beaches of Sydney where I live, there are no vacant commercial properties, zero. And then we used to buy quite a lot in areas like the Gold Coast. That's an area where most like the tradie type businesses are really looking to buy, like especially in their self-managed super funds for the location for their business. And that's further pushing around demand as well.
Yeah, I want to ask then just one more thing before I move on to the next, my next challenge question. There are some of those financial property influencers out there talking about regional property, and there's a lot of people buying commercial property in regional areas and they're going to get absolutely smashed. Is there some element of truth about that, or again, is the devil just in the details? Do you want to share your view on regional commercial property investing, and if it is a high risk, and maybe that's something we should look to avoid?
Yeah, so we typically avoid the regional towns, but again, it's going to be case by case. So typically the best return you're going to get from a commercial property is capital growth plus rental increases plus lack of vacancy. They're the three factors that are going to give you the best ROI. Typically in a regional area, the vacancy rates are higher. You're not getting a 0% vacancy rate. But again, it depends on what you're buying. So if you're buying a retail strip in a regional town and it's on the main street, there's only one main street. So the vacancy rates can actually be really tight on that. Whereas if you buy like a suburb or two over, they're really high. But let's maybe talk industrial for a little second. There's a lot of like buyers agents and influencers saying, oh, go out and buying Mount Isa and Rockhampton and Townsville and areas like that. And then they're also buying around 200 properties a year in that area. So we were speaking about this before, Jeremy. They're almost causing like a false floor economy. It's just the investors propping up. So those are the markets where I see are going to have a big softening.
Yeah. So again, you've got to make sure that when you are, investing in these areas, you've got to have a look at who else is investing. Because if there is a huge amount of investor demand, as soon as that tap turns off, there needs to still be underlying factors of what's supporting the growth or what's supporting the tenancy. One of my biggest things, I don't really care too much about hype. In fact, I often always counter invest. If people are going into WA, well, I'm looking in Melbourne. If people are going into Melbourne, I might be going back into Sydney. So I always like to kind of go against the grain, and this goes back to that old Warren Buffett methodology that he always invests in. I want to move on to the next question. I really want to challenge you on economic sensitivity. One of the biggest things is commercial property subject to volatility based upon the economy. Now, we know the economy is running hot, it's running cold. Everything was supposed to collapse during COVID. Commercial property was supposed to take the biggest dive that the country's ever seen. We all know the opposite happened. But what are the things that people need to be aware of? And this is the challenge I ask you. Economic sensitivity and how it impacts and affects commercial property.
Yeah, this is actually a really good question. And also where there's a myth about commercial doesn't grow, which is completely false, and we can touch on that. But generally, they grow exactly the same. Funnily enough, if you compare all types of asset classes, Sydney Industrial has been the best performer in 20 years. But on average, they all have kind of 6%-ish capital growth. But that's also where the myth comes from, because basically when the economy slows down, commercial stops growing, but residential sometimes can still grow. So they get this counter-cyclical. That kind of got distracted during COVID. But this is the biggest fear. People say, oh, when the economy turns, therefore commercial property is going to go vacant. That's not always the case. It depends what you're buying. If you're buying like, I don't know, a medical center in retail, or a hairdresser, or a panel beater, or a mechanic, they don't just die down. You might get a lack of rental increases, i.e. you can't increase rent, or maybe even give a rental reduction, but it's very unlikely if the businesses in suburbia aren't thriving that the residential properties are going to thrive, unless it's an investor market, like if it's an owner-occupied market, because the people who will live in that suburb generally use those services, so they have to remain on par. But yes, if there's a downturn in an economy, it also doesn't matter where you put your money, because generally, like houses, people go, oh, people need a house to live in. My counter argument is people always need a roof over their heads, and the roof comes from a warehouse. But that's also one of my principles at Palise Property is we only buy commercial property typically with a good land component, which is why I like things like warehouses, because it can actually be anything. Like sometimes you get mixed zoning, you can turn it back to residential and vice versa. But yeah, you need to be aware of what type of investment you're buying based on the economy. And this is where the nuance comes with commercial versus residential. Residential is pretty simple. You like look at vacancy rates, days on market, in population growth, infrastructure spending, what the future kind of looks like. Commercial, you have to do that. Plus look at what industry you're buying in. Is it going to be a long-term industry? So like there's some influencers say, oh, I love petrol stations. I think they're probably okay for around 10 years. I wouldn't be buying one to hold for 20, 30 years time, because electric cars are getting more and more popular.
So you've also got to really understand what's happening in the economy and where the economy is tracking, so that you can make the right decisions of buying properties that have a 20 or 30 year lifespan. So that's an important point. Something probably I don't look at too often myself. If I'm buying this, what will be the use of this property in 30 years? And that's where the risk is. If you're buying, these sole purpose buildings, they've got gantry cranes, Steve, or they might have mills or anything in there. What's your view on those rural sole purpose buildings? Have you guys seen, are you buying there, number one, buying those sole purpose buildings, number one, but do you see a significant economic risk to buying these sole purpose buildings like the petrol station?
We occasionally do buy them, but there has to be a reason for it. But we'll generally stay away from anything that's sole purpose. So like petrol stations, car wash, cinemas, funny enough, daycare. People absolutely love daycare centers, being like, oh, it's great, I got this 15-year lease, etc. However, if that closes down, you've just got this portion of land with a purpose-built center on it that you can't do anything with. So you basically have to knock it down and go again. So that comes with risk. The banks also see that as a risk, and we'll touch on this later. Lending, you can't get the same loan to value ratio because banks consider it a really high risk asset. But I generally don't buy anything that's one dimensional, because like I just mentioned, I have that 20, 30 year mindset. The general rule I always follow with my clients is I look at an asset, and I actually, funnily enough, don't care that much who the tenant is if it's a versatile asset. And I just say, in 10 years time, will this be in more demand land than it is now. So the simple way to do that is if I'm buying an industrial property and it's completely surrounded by residential, and I've done all my due diligence talking to town planners, looking at the council websites, and the population in the next 10 years is going to grow by 7-8%. It's cool. There's going to be 8% more people that are going to need car mechanics, wholesalers, distributors, kitchen fabricators, storage. So there should be more demand for that asset, which will hopefully in turn mean capital growth. But as we've touched on, capital growth comes from other factors, interest rates, the economy, supply and demand. But if I know that there's going to be more people that need that space, I know it's going to be a good long-term investment with minimal vacancy rates.
Well, then I'll ask the next question, because you've touched upon it, financing challenges. You know, typically you need a larger deposit to buy commercial property. The interest rates are a lot higher. The argument can be said that if you're having to put down a 20, 30 or even 40% deposit to buy one commercial property, could you then use leverage to go buy, say, 3 residential properties with the same amount of deposit? And, you know, does the capital growth that you would get from 3 residential properties outweigh the potential return of that one commercial where you've sunk in a lot of cash and has a higher interest rate compared to residential investment? What's your, I suppose, take upon the financing challenges, the high level of deposit required, and when should I be looking at going into commercial property as opposed to staying in residential, focusing on a little bit more of a leverage strategy?
Really, really good question. So like on paper, commercial is a better performer like for like. Like as I mentioned, you actually get the same capital growth and you get 3 times the cash flow. So on paper, you're like, this is awesome.
Sorry, you're saying 3 times the cash flow twice. What do you mean by 3 times the cash flow on commercial property?
So generally you can buy commercial between a 5 and 6% net yield. And the key word is net because the tenant typically covers council rates, water rates, maintenance, outgoings. There are some little things like property management, but again, I'll take that into account with the calculation for net yield. Residential at the moment, what are you getting? 3.5% on average as a gross yield. Then on top of that, you got council rates, water rates, maintenance, vacancy, all that. That generally is going to whittle down to a 1.5, maximum 2% net yield. But we're getting 5 to 6% net. So we're physically getting, at the end of the year, 3 times more cash put in our pocket as a net result. And that's powerful because you can have a portfolio that's a third the size. And this is going to answer your question a little bit as well, with the same cash flow as a residential. So on paper, 3 times the cash flow, same capital growth. The negative, as you touched on, is you don't get to the same leverage. Like maximum, you're going to get a 70% loan to value ratio. So that's a 30% deposit. And this is the answer to your question is the whole game of property is a game of leverage. Like I actually don't care about property as an asset class. I just like that the banks will lend me lots of money for a small deposit. And that's the game of property. It's a game of leverage. With commercial, because you've only got that 30%, if you're starting out and you've got the possibility, let's say you're a 25-year-old and you've got a deposit saved, I would much rather in the foundation stage, you go out and buy 3 residential properties on 90% loans and pay lender's mortgage insurance, because as you alluded to, if you get the same capital growth, you're going to have made 3 times as much. And then that's the kind of decision of when you go commercial. It's going to come down to typically what you're trying to achieve over what time frame versus what you've got to work with finance. And finance is normally the one that dictates it early on. If you're a bit later, like let's say you're 60 years old and you're looking to build a passive income for retirement, going out, even if you've got more leverage in residential, going to buy a negatively geared residential property doesn't really help you with retirement. So you're going to go commercial because your first goal of what you're trying to achieve is there. So it's a balance between those things.
So I always talk about on this show, Steve, you know, the balance sheet versus the P&L. When is a good time to be focusing on the balance sheet? You know, it's a time when your income's strong, you might be working, you've got a great business, and, you know, you can capture and chase a little bit more of that capital growth in lieu of having to spend money to hold it. Then the older you get and, you know, the more wiser you get, the more you start to focus on the P&L, the profit and loss statement, which is converting a balance sheet to actual profits, which means having a property or assets where it's providing you cash flow, income to live, as opposed to what the value is on the balance sheet. But a good point you made, you know, the younger people looking to start your foundation property portfolio, going ahead and trying to maybe buy commercial property straight away, not necessarily a bad thing, but you might be missing out on that really good juicy capital growth that will give you chunkier deposits. Because as Steve mentioned, 30% or even 40% deposit requirement, that can come from a very healthy portfolio of residential properties that you may look to sell down. Now, Steve, I want to just touch upon what you did, because to overcome some of those financing challenges and cash requirements, you had a very large residential property portfolio to start with.
Yeah.
And Just want to explain why you decided to sell down and what was the trigger point for you doing that?
Yeah, so this was generally a personal decision. So I found the larger my portfolio got, I wasn't getting any happier with it. Like, I'm one of those people that doesn't care if he's worth 5, 10, 15, 20, 30 mil. I'm more passive. And as you know me quite well, Jamie, like I travel the world 4 months of the year and kind of like I enjoy experiences more than net wealth. And that's not taken away from anyone else's net wealth. Like, there's plenty of like parents out there like me that want to build a big, large base for themselves to hand on to their kids, or they absolutely love the job and they're going to work out for the next 20 years. So buying a passive, but I sold him a residential to then buy a couple large commercial assets that will give me a big passive income. So I don't have to stress about the day to day. And again, I'm not one of those people that are like the buyers agents that want to be a billionaire. It's just purely because it gives me the lifestyle now. And that's the points I touched on before about what you're trying to achieve and what time frame. I wanted to achieve a large passive income in a short amount of time. So that's why I'm selling it. Theoretically, like I've got a low loan to value ratio on my portfolio, sub 50%. However, I could have leveraged up. The banks will give me 12.5 mil extra right now if I want it, but it means working for the next 15 years and making sure my business is still successful and doing that to be in a better position in 20 years time. Because if that 12 mil portfolio doubles, I'm going to make an extra 12 mil. So I'm sacrificing future wealth for lifestyle now. And that's about getting the balance. And it wasn't an easy decision, but it just felt right.
Yeah. And everyone's got their own journey to take on their life. And again, that's important. You can't just look at somebody else and say, I want to follow in those same footsteps, because you've got to also find your own walking track as well.
One of the points I wanted to touch on, Jeremy, is people will say, well, when do I shift then to commercial property? And most of my clients actually come from people that are out, they're basically done with their servicing for residential. So they've built their residential portfolio, but the banks are saying no. They've still got equity there, they just can't leverage it. But commercial, you've got access to these things called lease stock loans, and you need a big deposit for those. It's typically 30 to 50%, but basically they'll look at it in isolation and you can keep buying if you get that deposit. So a lot of people shift over at that point, or they're like me, they just want to start building a passive income. The other ones are people buying in the self-managed super funds. So commercial's making a little bit more sense than residential at the moment due to yields to buying in a self-managed super fund. So a lot of people are doing one of those two.
So look back in one of our prior episodes, I think we had a chat with Nick Wilcox. We spoke about commercial investing, utilizing lease stock loans. And as Steve said, some people might be absolutely tapped out from a borrowing capacity perspective. They might have this huge amount of locked equity, which they can't access. They can't extract the equity. So they will then sell that residential property, realize the profits, pay the tax, then move that cash into commercial property without having to impact their borrowing capacity, because they're going under a very special product called a lease stock loan. And you need to make sure you've got the right tax structure, because the bank's looking for the structure to also give you the lease stock loan. But it's an important point. I want to move on to specialized knowledge. Now, do you need to be a scientist to be able to find good commercial property? Because one of the things that I always say is that if you need a buyer's agent or a scientist to be able to find good commercial property, then how is this asset class going to grow? Because 90% of people or 95% of people can't actually access, say, professionals to be able to buy it, or don't have the knowledge to buy it themselves. So if we're talking about a very small amount of population that buys commercial property, how is this a feasible asset class long term?
Yeah, really, really good question. So funny enough, so about 7-8 years ago when I started buying commercial, every time I did a sales call, the client had no idea about commercial. Like you mentioned, like lease stock loans and the tenant paying the outgoings, and I had to explain every facet. Every call went for about an hour and a half, and that was the premise of my book. I wrote the first commercial book on the market of going on the ins and outs, but it is more complicated, but it's not hard. There's just more steps. The way I explain it is like a downward staircase. Residential is 3 or 4 steps up the staircase, and they're the things you can trip on and hurt yourself. Like you might go, I accidentally bought in a flood zone, or a house with termites, or high vacancy rates. There's a few things you got to check. Commercial, you're out 15, 20 steps up, because you've got all those things. You've got lease reviews, contract reviews, tenant interviews, road and traffic analysis, vacancy study, occupancy study, check leases are registered, check maintenance schedules. There's all these other things you need to check. It's not hard, it's just a lot of work, but there's more things to trip on. At the top of the staircase is probably development, because you've got all those things, plus you've got the building and all that type of stuff. So there's risk profiles with it, but there's so much more education out there. Like I've given away 50,000 of my books, and I've got a commercial course where 12,000 people have done it. There's other buyers agents now that have books. I think there's about 4 books on the market. So collectively, there's probably $300,000 people now that are educated on commercial. We're on this podcast. I've got my own podcast. Other people got their podcast. People are switched on, and this is one of the non-data metrics that I think is going to actually make commercial grow? Because 7 years ago, it was basically limited to a few individuals and business owners. Most of the people buying commercial were like someone who had an industrial property for their business, and they went, oh, this is really good. I'm just going to buy another one around the corner and get someone else to pay off the mortgage. Now there's 200,000 people in Australia plus educated on commercial versus 5-10 years ago where there might have only been 5,000. And as we know, it's supply and demand. I think that demand is actually going to keep the cap rates compressing, i.e. capital growth, and that's going to keep it moving forward. And then it's only going to get easier with AI as well.
So I always, and look, I've been guilty of this. I've always said, that sub $1 million market, if you've only got $1 million to invest in the commercial property market, it's really hard to find properties. There's too many people that are inexperienced. They're paying overs. They're not actually looking at the numbers. And obviously the higher price you get, the more sophisticated people are, and everybody's playing the same game, to the same tune. What's your thoughts on that comment about that sub $1 million market? And if it is saturated by inexperienced people, is that an opportunity or is that a risk? Because I know I've been guilty of saying that in the past simply because of what I've seen, but is there silver lining to it, or it is a genuine risk you need to watch out for?
A bit of both. So funnily enough, if there's more people looking in an area, that's demand. So we should get capital growth. But counter to that, it actually is really hard to get a good asset. Like sometimes it takes us 3 to 6 months to actually find a good asset. However, that's just because we're trying to buy well for our clients. If you're happy to pay a little bit of a premium, you can still get a good quality asset. There's a bit of a difference. So let's maybe use like a sub $1 million industrial property versus a $2.5 million industrial property. The smaller sub mil one, don't expect like a big long lease. Like you're not going to get a lease stock loan on a 5-year lease that covers itself. It's going to be average Joe's family services or whatever it is, like a little business there with 1 or 2 people. They're going to be a volatile tenant. So because they're going to come and go probably every 3 or 5 years, because they're either going to grow and outgrow the space, or they're going to close up shop like most small businesses do. However, where we're buying, the vacancy rates because of that demand are really short. They're 1 to 3 months. So you're getting a slightly lower yield, more volatile tenant versus if you went, say, a big $2.5 million one, you're getting a tenant who's going to stay there for 5 to 15 years, sign 3, 4, 5-year leases, be a bit stickier. However, if you lose that tenant, it's probably 6 months vacancy because you have to wait for another big tenant to come in. So there's a pro and con of each. Like my brother who works in our due diligence team, his strategy is going to be buying lots of $500,000 warehouses, and he's using that as a diversification strategy. I personally hate that because I feel like my time's more precious than managing lots of these tiny little issues.
Yeah.
I just want a bigger asset with less headache. But again, people keep saying, and like there's influence in the market and educators that go, don't buy sub-mil, there's too many buyers. If you went to an auction and there was 300 buyers, isn't that a good thing? Isn't that going to be like, this market's moving? It's not at the top. It might be somewhere near the top, but it's still a good time to buy.
Yeah, so it's an enticing thing to consider. So, if you're talking about, say, 300 people lining up, and we're using exaggerated numbers, of course, but if the sub $1 million market is so in demand at the moment, what is not in demand? What's that? What is a risk in that sub $1 million market that people should really start to consider and maybe stay away from? Is there any wisdom you can give as far as that's concerned?
Funny enough, about 5 years ago, I used to say car parks in the city were done, and the prices were about $80,000. I've actually proved wrong on that. They're worth about $150 to $200, so they've still done all right. Generally, the highest risk ones I see are regional retail shops that aren't on a main like heritage listed street. So the ones I'm talking about just in suburbia, where a lot of novice investors would be like, oh, it's great, I found this 7% hairdresser in this random suburb in regional Australia. The vacancy rates on those are, or sometimes infinite. It's like 2 to 5 years, and you can't actually get the number because you don't have enough comparables. Going out and buying like a $400K retail shop like that with an unknown vacancy rate is really, really high risk. You can still buy good ones though. So Jerry, you mentioned like I just bought like a shopping center for 3.175 mil that has 8 tenants. So that's effectively the same thing. I could have bought those individually. I knew when I looked at that center, in the last 10 years, there was only 2 vacancies, and the longest period of vacancy was 6 months. So I knew that was a tightly held area. And to prove this, I actually kicked out the tobacconist tenant of that location because insurance premiums are high. And I had 3 people apply in the first 3 months. I had 2 barbershops and a nail salon, and I jumped on the nail salon because that was a tight one. So there's not bad. I could have actually bought one of those shops individually and it still could have been good. But if you do the same thing in regional Australia, different different game.
So the sub 1 mil, there's plenty of opportunity. You still just got to make sure that you watch your pennies because you could be overpaying, but there's a lot of demand, and that demand might translate into lots of capital growth. So yes, why it might be harder to buy in that sub $1 million price bracket, if you're willing to stick it out and spend the time and be patient, there might be an opportunity. But obviously more you've got, more you start to work in the same parameters as everybody else, because when you're going into that $2.5–3 million price range, they're all looking at the same numbers, all trying to achieve the same results. It's just really who's got the best relationship and who's willing to put forward the best offer as far as sometimes terms are concerned, not necessarily price.
One of the points I want to touch on there, Jeremy, though, is there's a lot more work involved in finding that property as well. So residential, once you know your budget, you can basically pinpoint a couple suburbs that you really like, and then you just got to watch the market for a couple months, and generally something will come up. You don't have that luxury in commercial. Like, I've got 6 acquisition guys looking full-time all around Australia, and it's taken us 3 to 6 months. So unless you're willing to sit there on the couch every single night looking around Australia, let's say even just like your best bet probably for sub 500k or sub mil is probably Perth at the moment, industrial Perth. You will be there for months looking, and it's not like sitting on the couch looking at houses on realestate.com going, oh, that's pretty. You need to find one, then you need to go away and do 2 or 3 hours of due diligence before you even make an offer. And most people aren't willing to do that work, and that's why you don't get the reward from commercial.
And is the time that it's taking because, I'm sorry to divert, but is the time that it's taking because the properties aren't there? The properties are overpriced? What is the reason why it does take a lot longer? Because it's what the general consensus is, buying commercial property is a much more involved process. But why does it take longer, and why is it taking you longer at the moment?
Annoying combination of both. So ones that do come up are overpriced because there's too many mum and dad investors paying a premium for it. We don't do that for our clients because we know generally the commercial subject to evaluation, and because we've got 3 valuers in our team, qualified valuers, we know that's going to come under the purchase price. So for our clients that don't have that cash to top it up, they're not going to get the deal done anyway. Then in addition to that, just waiting for the right properties in the right suburbs, because we only buy in the tightly held vacancy rate regions. There's not many, whereas the everyday mum and dad investor don't know how to assess vacancy rates, so they're just looking in every suburb. Then there's nuances as well. There's even like good parts of industrial areas and good parts of regional areas, retail strips that you have to know, even to the micro level. So one of the examples I use is if you have a really long retail strip and there's a car park at one end, vacancy rates go higher the further you get towards the end of the retail strip. So people going, oh, I looked at the retail strip, the vacancy rates, and they use a shop at the front start that went vacant for 3 months. The one at the end, because of the lack of foot traffic, can actually have a 10-fold vacancy rate. So there's all these nuances you need to know with commercial property.
Yeah, beautiful. Now, I suppose I want to leave our viewers with some opportunity there, some things that they can look at. And, we've gone through all the various different risks, and I've, challenged you some questions about the opposite side of commercial property. These are things that can go wrong. What do you need to do to look at it, to, assess it and make sure that you don't fall into that trap? Where are some of the areas that people can do their own research on, and maybe some of the asset classes, Steve, that they can start to review themselves if they're interested to get into the commercial property market? Where's your next tip for, say, the next 12 months?
Again, this is a really hard question to answer, Jeremy, because it's going to come down to what budget you have versus your risk profile versus what you're actually trying to achieve. Generally, we're buying a lot at the moment in Canberra, Brisbane and Perth in industrial and retail, just because we find we get the best bang for buck in regards to yields versus risk. However, we're starting to buy quite a lot in Sydney. So where we're buying in Perth for say 6 to 6.5% net, now they're compressing down to closer to 5%. And Sydney now all of a sudden at 4.5% is looking really attractive with its 0% vacancy rates. But I'd assess what your budget is. If you're a first time investor, I would stick to industrial because it's a lot easier to get a grasp on the numbers. Like you can look in an industrial complex and find what ones went vacant, how long they were vacant for. You can compare like rental square meter rates, sale square meter rates. It's a bit more of a mathematical decision versus retail, for instance, where it's a bit more business decision. However, a lot of our clients that are business owners in retail, they love retail because they understand it. So we're looking for them. But I'd say for your first time investor, probably stick industrial just because you can get a grasp on what the vacancy rates are and what the risk is going into the investment.
And state changes are moving away from WA now into, say, somewhere like Sydney, where the yields now are very comparative with each other.
Yep. And this is the counter argument as well, is if vacancy rates are really, really tight, which they are in most of the areas we're buying, that actually transforms to rental increases. So like some of the areas we're buying in Perth had a 0.5% vacancy rate, and we're like, this area is going to grow. And has in the last 3 years, the rents have gone up 20 to 35%, which has then in turn turned into 20 to 35% capital growth. We had a client we bought in Canning Vale in Perth. 3 years ago for 800,000. They just got their property valued by the bank for 1.6, and they've done nothing. Like they've literally done nothing. I can actually see Sydney doing that next because, like I said, the vacancy rates are so tight. But there's external factors. Again, I try not to pick the next 12 months. I try to pick the next 3 years, but focus on the next 10 years in regards to demand.
Beautiful. Well, Steve, I really want to thank you, and I really appreciate your time, especially to all the listeners of What Schools Should Have Taught You. I wanted to ask you the questions that a lot of people have. They think about it, but they may not have the confidence to ask it just yet. And I think it's armed people with the right questions to ask their professional, things that they need to be considering, things they need to maybe stay away from as well. And, thank you for giving some of your thoughts of where the market may be moving to and what type of asset they should be investing in. Steve, thank you very much for joining us today on What Schools Should Have Taught You. If you want to have a chat with Steve, you can visit one of his numerous books, Commercial Property Explained Simply, Residential Property Explained Simply. I think you've got a development book now, Explained Simply. So he's an author as much as he is a commercial property specialist and buyer's agent. But if you want to talk to him, you can visit him at paliseproperty.com. You'll see that come at the bottom of the screen, paliseproperty.com. Thank you very much, Steve, for your time today. It's been very much appreciated.
Awesome. Thanks for having me on, Jez.